ITC's current stock price is very similar to what it was back in 2014, 2015. So, in the last 5 to 6 years, the returns have been either zero or even negative for most investors. But does that mean that the business is also as bad as its stock price performance? My name is Shreyans, and today we are going to take a step back or step aside from all the noise around the stock price performance and try to understand the business that ITC is. Let's get started. So, as you would know, there is already a lot of division in the market with respect to the opinions about the companies. Some say it's a very poor company, then there is also negative sentiment, especially due to cigarettes. Some people believe that it is going to be a potential wealth creator in the next decade. And today we are going to understand the business because we know that eventually stock prices will reflect the performance of the business. Right. So before we start, very important disclaimer that please do not use this video or this presentation or anything I communicate as a basis to make your investment decisions. You should do your own research because it's your money and then only you should invest or take any decision, right? I've primarily used the information provided by the company and a little bit of coverage about the company in several places, right? Very important disclosure that I am invested in the company, but I have tried my best to present to you a balanced understanding of the business. Having said that, it's very natural that since I'm invested, I might be biased. Let's get started. So first, let's look at the financial performance of the company. So if you look, I have a 10-year overview here, and if you look, that the revenue has slightly more than doubled, right? And EBIT performance is also, the EBIT growth here is also very decent, and PAT growth is even better, right? So you could see that the PAT growth is greater than EBIT growth, which is even greater than the revenue growth. And the margins also, if you look at currently, the margins are at very near to their decades high. The challenge here is that the growth in the recent years has not been so good. So if you look at from FY16 to FY20, only in FY19 there was a double digit growth. In the remaining 3 years, the growth wasn't that great. And a similar story can be found in EBIT and PAT. So there was some inconsistency with regards to EBIT, and with PAT also there have been a few years where the performance hasn't been that good, right? But overall, I would say it's decent performance because the PAT growth has been decent and it is even better than revenue growth, right? Now let's take a look at the financial position of the company. So here I have extracts from the balance sheet of the last 10 years. As you can see that the equity has gone from around 16,500 crores to 65,000 crores. So you could see that there's been steady increase in the book value of the company, right? In the book value of equity, so to speak. And there have been very continuous investments in the non-current assets as well, right? Because we know that the company has taken very substantial expansion programs in the last few years under different segments, which we'll take a look at. And if you talk about liabilities, then liabilities are, to be honest, very negligible, right? Because if you look at liabilities, they total to about 11,600 crores, and there are easily covered just by the current assets, right? So from a leverage perspective, the company practically has zero debt, right? So consistent compounding in equity, asset growth is slightly higher than revenue growth. So revenue growth was around 9.1%, asset growth is around 12.7%, right? And that is why the asset turnover has sort of declined. And finally, negligible debt and insignificant liabilities overall. So from a solvency position, very strong, right? Finally, we have an extract from the cash flow. This is not the entire cash flow. I've just taken the operating cash flow, the investments, and the shareholder payouts because these are the major items. The important thing here to understand is that operating cash flow has been able to take care of the reinvestments and the shareholder payouts in nearly all of the years, right? So the company is generating a lot of cash flow from operations primarily due to its cigarette business, right? The growth in operating cash flow is slightly lower than PAT growth. So it was around 12-13%. Here it's around 11.5%, right? The CFO growth. Shareholder payouts have been consistently high. So if you look at here, the trend has been broadly on the increasing side, and the company also has announced its policy to pay out 80 to 85% of its earnings as dividends in the medium term, right? And consistent reinvestments into expansion, right? Similarly, as we saw, the company has invested quite a bit to expand its various segments, right? Now, here are the metrics also for the company. The broad trend here in ROC and ROE, they are near minimum, but they are still healthy, right? So if you look at the minimum ROC is around 26% and the minimum ROE is around 21%. So still very good, but I mean, in the recent years, they've been slightly depressed compared to the earlier years, right? Margins at the highest, as we saw, and asset or capital turnover, which reflects the utilization of assets, is at its lowest. So that is because the expansion has been significant, right? So the revenue growth hasn't been in line with the capacity expansion that the company has done. And the cash conversion is also very strong, right? So if you look at the median CFO to PAT, it is 101%. So the company is generating it's is able to convert its profits into cash flow, and those are not just accrual profits, so to speak. And if you talk about leverage as well, very comfortable leverage positions. If you look at the asset by equity figure, it has, I mean, it has never crossed even two, and currently it's around at 1.18, right? So very comfortable solvency position. So these were the basic financials of the company, right? Just to understand how the company's numbers look. And now we'll get into the business. So as you might know that the company has six broad segments, cigarettes being the main. Then the company also has FMCG. There is a paper and packaging business, the hotels business, the agriculture business, and also an IT services business, right? So I've tried to analyze the different segments or the different business lines using the BCG metrics. And from my understanding, I would classify the FMCG, agriculture, and paper as star businesses, cigarettes as the obvious cash cow, right? Hotels as the obvious dog, and IT as a question mark, which can be classified elsewhere as well, but I'll quickly explain my rationale as well. So cigarettes are obviously the backbone of the company. I mean, they produce so much cash, which has been used by the company to, expand into all of these various segments, right? To for capital expansion, capex, for also for shareholder payouts, right? So cigarettes just are the growth is not so much, but the cash flow is very strong, right? Then you have FMCG. So the company started its FMCG division around 2000. I guess in the last 20 years, it has grown to become the second largest listed player behind HUL, right? The growth has been very strong, but the profitability has been very weak. In fact, it's probably the lowest amongst its competitors, right? But that is something that you expect from a star: high growth, low profitability, which we can expect to improve in the future, right? Now, the reason I classify hotels as a dog is because, I mean, the amount of capex that hotels require and the amount of contribution to its earnings, it just doesn't seem logical, right? Because there's so many assets and there's very little contribution to the earnings. If the hotels were a standalone business, then I think it would have been very difficult for it to survive on its own, right? Now, talking about agriculture, so agriculture probably has the greatest strategic importance for the company, right? Because it helps the company, it's a backward integration for the FMCG and also for providing paper, leaf tobacco exports as well. So the company's agriculture division is very important because it helps it to create relationship with farmers, source material as per its requirements, and so it's basically capturing the entire supply chain or the entire value chain, right? Now we have IT services industry. So IT services industry has had very good growth that we'll look at later. But the reason I've classified it as a question mark is because the IT services industry is very large and it's very competitive as well, right? And ITC's IT segment operates at the lower end of the industry in terms of revenue. So although the growth has been good, but its contribution in terms of revenue, its size in terms of revenue, this is something that is not very significant, at least at this moment. But the industry fundamentals are very favorable, so this is something that we'll have to wait and watch for a few years before it becomes a very before it has meaningful contribution to the business, right? Then so when it comes to the final segment, which is paper boards and packaging services, so company is the leader in India and also in certain segments in the entire Southeast Asia, right? Although the growth has been low, but because of its leadership position and because of its product portfolio, I think it is better classified as a star business, right? So these are the this is an overview of the businesses, and now we are going to look at the performance of each of these segments as well. But before that, a quick look at the trailing 12-month performance. So this is the performance of the last 12 months. So I mean, 2 quarters of financial year 20 and 2 quarters of financial year 21, right? And so if you look at here, then cigarettes contribute the maximum in terms of revenue and also in terms of EBIT. So you can say that virtually cigarettes is the only cigarette virtually has the greatest profit contribution, and company's entire profit is virtually attributable to cigarettes, right? Its revenue contribution has come down for obvious reasons because of the FMCG, agriculture, and other segments as well, right? And you look at here that the company has invested most of its assets, or the most of its assets are there for the FMCG division, because the company's commitment to grow and become primarily an FMCG company rather than a cigarette company. But still, in terms of profit, cigarettes are pretty much the bread and butter of the company, right? Now, agriculture also is very large in terms of revenue contribution. So it has about 22% revenue share. But the thing here is about 40% of it, so let's say somewhere around 4,300, 4,400 crores of this is actually inter-segment transfers, right? So agriculture and paper division, they both have sufficient inter-segment transfers, around 40% for agriculture and around 30% for paper division, right? So let's say about 4,400 crores of agriculture and about 1,500 crores of paper are actually inter-segment transfers, because the company needs to package its own products as well, right? And the other segment here is ITC, right? So cigarettes remain the primary profit contributor. FMCG has highest capital allocation, but as you can look on a TTM basis, its margin is 4.8%, which we'll explore into detail in the coming part, right? Others include ID services. On a standalone basis, the performance of ID services is actually decent. The return on assets is good. The margin is good. The asset utilization is also fairly decent, right? So, I mean, it's one of the smaller divisions in the company, but still on a standalone basis, its performance is good, right? Paper and packaging ranks fourth in revenue, right? So, I mean, after cigarettes, FMCG, and agriculture, but second in profit share, right? And again, if you look at it in a standalone basis, then good, decent return on assets, decent margins, and okay asset turnover as well, right? Hotels have significant capital allocation. So if you look at hotels, it's about 7,500 crores in assets, which is almost equivalent to the paper segment and slightly lesser than the cigarette segment, right? But its contribution to revenue is just 2.4%, and in fact, it is dragging down the profit of the other departments or other segments as well, right? And agriculture ranks third in revenue share, but as we spoke about, it has significant inter-segment transfers as well, right? All right, now we'll move on to analyzing the performance of each segment one by one. But before that, an important thing is the future outlook. How do I expect the future of the company to be? Starting with cigarettes, I think in terms of volumes, the volumes will be depressed, right? The environment in which cigarettes operate, it's not the most favorable one, because consistently taxes are increased, there is illegal trade, so on and so forth, right? But from the point of view of the company, cigarettes are extremely important, because as we saw, 84% of profit is still via cigarettes, right? So they will continue to remain the bedrock, right, till the FMCG business matures, which might take anywhere between around 8 to 10 years for it to reach a good scale in terms of profit generation, right? So the cash generated by cigarettes will be used for dividends and also for expansion, the organic way or even inorganic way by acquiring companies. Then we have FMCG, right? So FMCG, I think, will witness good revenue growth, and the company has committed to introducing new products. The last year as well, it introduced 70 to 80 products. Even with COVID, they have continued to push on new products, and they are more interested in, introducing premium products as well, right? So the company had strongly, or I mean, heavily invested into the asset capacity, right? Due to which the asset turnover has been slightly depressed, but I think its revenue growth will see better improvements. It will, and also with better asset utilization, we'll see that the profit growth would also be good. But it might overtake cigarettes in terms of revenue, but in terms of profits, it's virtually impossible for FMCG to become the primary profit contributor, at least for the next decade, right? Now, agriculture. So, agriculture, I feel, has the potential to become the source of competitive advantage, or you might think that it is already the source of competitive advantage. This is something that I leave up to you, right? Because it is there at the start of each value chain, right? So, all the products that company is able to source from the farmers, right? And the company is able to use for its FMCG products and also, for exports as well. So, the relationship that the company has made with farmers and its whole infrastructure, that is extremely key. right? Now, paperboards and packaging, I think, will consolidate its leadership position in the market, right? And the reason I say that is because of the product innovations, mainly because I think that there will be a lot of change in packaging with respect to moving towards biodegradable alternatives, recycled paper, so on and so forth. And the company does have a strong portfolio of products and strong capabilities for that, right? And the division will continue to contribute meaningfully in terms of both revenue and profit. The next one is hotels. I think hotels are, the problematic piece of this company at this moment, right? Although the company has changed to an asset-light model, but still, I mean, it will take at least 4 to 5 years to understand how the company's performance has been after switching to that model, and then only we'll be able to evaluate better that what's the contribution that hotels can make to the company. As of now, hotels are honestly best forgotten from an investment standpoint, right? Because the performance has been poor. Finally, we have IT services. So as you said, IT services is a good fundamental industry, right? I mean, you don't have very high capex requirements. Cash generation is good. I mean, the industry is very important because there is widespread demand for IT services or everything moving based to technology basis, right? So currently, it is at the smaller scale of the industry, right? I mean, we have giants as well, but even in the even in the mid cap companies as well, compared to them, it's still on the smaller side. So it will take some time to reach a meaningful scale, but you have seen that so many conglomerates, for example, Tata's have TCS, the Mahindra group also has Tech Mahindra, then there is L&T Infotech for the L&T group. So all of these conglomerates have also have a subsidiary of IT services that has performed well for the group. So this is something that could happen, but we'll have to wait for some time for the IT services segment to reach that scale. All right. Now, the value drivers and major challenges. So we'll look at a few factors quickly that I think will, impact the performance going into the future. The first is the integrated business model. So I think that is a very big strength for the company. As you've seen, agriculture serves FMCG and also leaf tobacco as exports, providing paper as well. And then the packaging business also serves agriculture. So and the IT services also forms the tech backbone for the agriculture business. So the model is quite intertwined, and each segment is complementing the other segments, right? The cash generation. So because of cigarettes, ITC is able to generate so much cash that even all its other competitors combined do not generate. So that is the quantum of money that ITC is able to generate specifically because of cigarettes, right? Then we have integrated production facilities. So what basically the company has done is they have set up new manufacturing plants which are going to manufacture most of the FMCG products, and they've been constructed or situated in a way that they can reach out, increase their distribution as well, right? So as these plants come into operation, I think this should be beneficial for the company. Then research and innovation. So this does not seem like an obvious one, but the company has a good research team as well, and because they're trying to introduce new products and premium products, then research becomes very important as well. Then we have operating leverage and margins. As I've talked about this, I mean, the capex has been on the higher side in the recent years, but now we'll see good revenue growth as the asset utilization improves, and as the asset utilization improves, we'll also see margin expansions, right? Talking about the FMCG portfolio, so most of the FMCG products of the company are actually either leaders or they have significant market share, right? Or they have no competition, right? And this is something that we'll also see when I talk about some FMCG products. So this is something that is very unique, right? Because FMCG is also a very competitive space, so to speak, and there are big companies present there, but the company has been able to grow very quickly because of its product portfolio, right? Then we have value added F&B products. So I think the company will keep on introducing more and more new products, especially with the support of agriculture in the in the backside, right? So it's able to use agriculture as a foundation, and also with all the research to keep introducing new products across different FMCG categories. And the e-Chopal 4.0, I will talk about it in more detail as well, but the thing is that the ecosystem that the company is creating for farmers, that could add tremendous value, not just to the agriculture industry as whole, but also to the company, right? Which we'll see very quickly. Now, what are the challenges? The biggest challenge I feel is currently sales growth. So, in the last 4 to 5 years, as we saw, the sales growth hasn't been the best. And this is not just for the company as a whole, but most of the segments, right? Apart from probably the IT services, in most of the segments, even in FMCG, there has been challenges around growth, right? Now, you could say that the economy as large hasn't done the best, but still, that is not really a good excuse. Right. Then regulations around cigarettes, we already understand it that cigarettes are an highly regulated, and in fact, I mean they carry a very negative publicity as well as an industry, right? The affordability is low, the illegal trade is also increasing, right? So that's a challenge. Then organized retail. So what happens right now is that the FMCG companies are very large and the retailers are local shops, right? So FMCG companies have more bargaining powers, but as the retail sector also organizes, retail sector meaning all the shops or the shop chains, right? Or through online as well. So we see the Reliance is getting into retail, DMart is a retail chain. So when the retail companies also start to get bigger, they will also have bargaining power, right? And that is why there would be an equal play here instead of FMCG companies being large, retail chains being smaller. Now, as it comes into balance, the margin expansions might suffer a little bit because of that. Next, we have the hotel business. I think it is a very, very big challenge because lots of capital has been allocated there, but the contribution to revenue and earnings has just been dismal. It's been very poor, right? Then finally, I think agriculture unpredictability. So even with all the efforts that the company is putting in into diversifying crops, diversifying income opportunities and everything, agriculture still remains an inherently unpredictable area, right? Because the prices of the produce is volatile, the volume of the produce itself is volatile, dependence on monsoon, so on and so forth, right? So it will be interesting to see how the company addresses these challenges. All right, so now we'll finally get on to each of the segments separately. Now, as you know, ITC is a virtual monopoly or almost a leader. There are other companies as well, but ITC holds a commanding 80% market share, right? And it has maintained its market leadership since several decades. It operates around 13 brands. I think the most notable or the most common ones of them being Gold Flake and Classic, but there are other brands as well, right? And here's the asset revenues and the EBIT performance of the company. And if we talk about the growth rates and the key metrics, so you could see the revenue growth rate is around 8%, EBIT around 11.1%. Now, considering all the regulations, the price increases and everything, I think this is a fairly decent performance, right? The asset growth is hardly much, right? It's only 4.7% because there doesn't need to be very substantial investments into the assets, right? The margin is around 67%. So this is an extremely high median margin, so to speak, right? Currently, it has in fact increased and settled around 70%. So these are just absolutely mind-boggling numbers, right? For 1 rupees of revenue, you practically have 67 paise of profit. So that is very high. And asset utilization is also very strong, and we can see this has also improved in the recent years. So despite all the regulatory requirements, regulatory difficulties, I think the cigarettes division, with its vital importance, has done actually quite well, right? Now there is also a lot of talk about cigarettes being banned as whole, and I think that is very unlikely because they form bulk of the industry. They form bulk of the taxes that is being paid by the industry, right? Constantly taxes have been increased, which has decreased affordability of cigarettes. And if you compare affordability of cigarettes in India versus other countries, then it's very low in India. And the illegal trade has increased to an extent that it was around 16% in 2011, but right now it's around 24%. So you can say 1 in 4 cigarettes that are being sold are actually illegal, right? Currently, the volume for FY20 stood at around 75 billion sticks, but it has not, the highest that was there was in FY12 to FY14, around 87 billion sticks, right? So 85, 87, 89, something like that in those 3 years. So that was the peak probably in the last 10 years. And then it has declined, and it will most likely, or it is virtually certain that it will further decline in FY21, right? Because of the lockdown, right? And also again, tax increases, due to which the company will have to increase the price, right? Because this is what happens. They, whatever tax increases are done by the government, the company just passes them on to the consumers, decreases affordability, drives down volumes, but still the financial performance stays intact, right? Now the company's sort of focus, in addition to strengthening distribution, has been on introducing new and premium products. For example, it recently rolled out hand rolled cigars at clubs and other hotels and sort of premium locations, right? So it's trying to innovate on that side as well. The next one is FMCG. So FMCG, we all understand what it is. The split is around 81% for food and beverages, 10% for personal care products, and the remaining 9% for notebooks, incense sticks, and all of those stuff. And here you see the different brands that the company operates. There are around 25 brands. These are few of them. So Ashirwad is the leader in atta. Sunfeast has a good market share in biscuits. Bingo has good market share in snacks or chips. Then Classmate is the leader in notebooks. Mangaldeep is the leader in dhupbattis and agarbattis, and Engage has a significant market share in deodorants as well. And I'm sure you must have used one of the products that the company makes. And we also know about EP, which is quite which is the second one in the noodles market, but it's fairly behind the Maggi that is being offered by Nestle. So this is the performance of the FMCG, and if you look at the metrics here, so the revenue growth is 12.4%, and so it's fairly decent, to be honest, right? So it was around what, four and a half thousand here to around 12,000 here, so it's decent growth, so to speak. Now EBIT CAGR optically looks very very high, right? Because it is only from FY14 to FY20. So you can see up till FY13, the company was actually making a loss. So the division started in 2000, 2001, but for the first 13 years, it was mostly loss making. So that is the sort of commitment and to growth that the company had, and now it feels that the commitment will shift to profitability as well. So as you can see, the assets growth has been actually higher than the growth in revenues. Assets have grown around 15%, and revenue growth has been around 2.5 percentage points lower, right? Because the company is spending a lot of money in the expansion. The margin, I mean, it looks very low, obviously, because in these 3 years the margin was in negative, and right now as well the margin is in single digits, which we'll very soon see. Asset utilization has been slightly depressed in the recent, let's say in the recent 4 years, it's been around 1.5. Earlier it was high because of the increase in capex here, and now that the capex will stabilize, we might expect that the asset utilization will improve, right? So major capital expenditure is being completed. Currently, the company's capacity is 10 factories for food and beverages, 3 factories for personal care, and 3 ICMLs are under construction or they might have been commissioned. This is as per the annual report 2020, right? And due to which, so this is basically the capacity of the company. Now, ICMLs basically they're integrated supply chain and production, right? So they're like a hub in a sense, and they are situated in a way that they are able to provide the freshest products as well, which is quite key in FMCG, so to speak. Right now, the in the most recent quarter results that came out, the EBIT margin for FMCG was around 7%, 7.2%. Now, I expect this to move up to around 15% in the next 5 years, and by a further 5 percentage points by another 5 years, right? Now, this sort of rough estimate is based on how the margins have expanded for other FMCG companies as well. So for HUL, it expanded by from around 12% to 20% in 8 to 10 years time, right? So I would expect a slightly faster initial burst in the margins of FMCG, and then sort of stability between 15 to 20%. Right, the ITC has around 25 brands with annual consumer spend of around 19,700 crores. I know this looks more than the revenue figure here, but that's because this is a gross figure, which also includes the GST and other taxes as well. But the scale is very large, right? The distribution also, it has a very wide distribution network, probably the second largest among the listed companies in India, of 6 million plus retail outlets. And obviously because of the lockdown, they also introduced online methods, partnering with Swiggy, Zomato, and other food delivery startups, and right, and its products reach around 140 million plus households in India. So that is quite a significant number. As I was talking about, there have been continuous new product launches, and the launches are done in such a way that they are expanding into different categories. For example, the Be Natural juice was introduced a few years back. The flavored milk product was introduced very recently, and they're also introducing new products in same categories or under same brands. For example, ghee was also introduced under the Ashirwad brand as well. Right, so that is what the company is trying to do with respect to FMCG. Now they're trying to add more value through its products or increase the the premium versions of the product, so to speak, with a focus on improved asset utilization and margin expansions. Right. Now let's move on to agriculture. So in order to understand the agriculture business, we have to understand two things. The first is are the products or the commodities that the company sells. So they sell it locally and they export it as well. Leaf tobacco, I mean, it's the thing that goes inside cigarettes, right? Then you have other crops as well: rice, wheat, and processed fruit, shrimps, prawns, coffee, soy meal. All of it actually started with soya. The whole agriculture revolution that the company sort of started, right? So the whole infrastructure of each opal that we talk about here actually started with soya. Now, as we all understand that agriculture is a very unorganized sector in the country, right? It has significant contribution in the economy, but still, it's still fairly unorganized. And you can obviously know that, a lot of times farmers also don't get their due. And each opal was sort of a solution to this. So the company tried to leverage technology and build a entire supply chain where they interact with farmers at the ground level. And they have a marketplace. They help farmers with different things on crop advisory, which crops to grow, how to diversify their income, additional opportunities, so on and so forth. So this was also more or less introduced around the same time as the company started its FMCG, around the year 2000. And till now that the company has around 61 installations or kiosks, or small establishments in different villages, you can say. And they have reached around 4 million farmers across 35,000 villages, right? And right now, the company are trying to switch to a mobile app rather than a physical establishment as well, so it can reach even more farmers. So what they're basically trying to do is standardize the quality, the supply, the pricing, right? So it also helps the farmers and it also helps the company massively, right? So this is the financial performance, and obviously you can see that because of the nature of agriculture, it has been slightly volatile. The revenue as well and the EBIT as well, because it fell here in the recent years, right? So a revenue CAGR of 9.2%, although this looks decent, but there has been quite a bit of volatility. EBIT CAGR is understandably, or I mean, actually quite low compared to revenue, right? Because here the performance would be good, but in the 4 to 5 recent years, the performance has been relatively flat, due to which the number is low, right? The assets CAGRs, the company has been investing as well. So asset CAGR is slightly lower than revenue CAGR, so that's okay. The margins, the median margins are probably around 10.5%, but in the recent years they've been declining, right? Due to which you can also understand the fall in the EBIT or in the profit, right? Asset utilization has been very decent. So also in the recent years, it has sort of stabilized around 2.5x, right? So in that sense, the company is doing well, right? Now let's understand the value that agriculture adds. So it is the foundation of all value chains for the different products that the company sells. So for example, Ashirwad is a very big source of revenue for the company, and they are able to procure wheat using their agriculture department. Similarly, for chips, they are able to procure potato. For juice, they're able to procure fruits, so on and so forth. So that is what, at the start of the supply chain or at the start of the value chain, they have their own division, they have their own procurement process, and they're also selling those products as well, right? The sales mix is around 60% external, which is comparatively volatile, that's understandable, and around 40% inter-segment. It has not changed too much. It has increased and decreased, but it has been this way for quite some time, right? Now my understanding here is that the company's focus is on exports and on internal sales for obvious reasons, so that it can help FMCG grow, and external sales, or sorry, exports, because the best quality produce in India gets exported, and you are able to get the best prices for that as well. The leaf tobacco exports have been, I mean, quite weak in the recent years as per the company. That's understandable because of all the regulations around tobacco as well, right? Now the value of each opal. So they're able to form very deep relationships with farmers. They're able to, offer farmers the benefit of technology, the benefit of, a marketplace, the benefit of advisory. They're able to show them that this is how a model farm should look like. So in using all of those things, they're able to build relationships with farmers. Farmers also get benefited if they are all having all of these things, right? That is why they're able to reach so many farmers, and that is that is quite certain to give them advantage with respect to this field, right? Now, their aim is to expand e-Chopper to 10 million plus farmers. Currently, it's around 4 million farmers, right? So that's quite a big number, and I think it will take some time. But they are trying to ramp it up by moving from kiosks, which were small setups, to mobile apps as well, in order to reach more farmers. But we'll wait and watch how this turns out. Even at this moment, it's very strong, and if they're able to further enhance it, then it only helps the business more and more, right? So as I talked about the different ways that they support farmers through best practices, technologies, advisory, so on and so forth. And they're also investing back into the community or giving advice on livestock. They're training the farmers, they're providing education to the people there as well, right? So that is something that goes along with the whole ecosystem that they're trying to create for the farmers, right? Moving on to the next segment, which is paper and packaging, right? So I would understand that packaging is the older one, and the papers have been introduced more recently compared to the packaging, because packaging requirements were internal to the business for the FMCG products, right? So the company has a good range of different products for paper boards, specialty papers, which has been the most recent, and packaging also, different sort of packaging services, right? So this is the performance, and the thing that you can probably understand here in the performance, it has been stable, right? The growth hasn't been that good, so you could see a very similar growth in revenue, EBIT, and assets. So it has been stable, but it has been low. But the company also has very significant market share. The margin is good, and the asset turnover is also decent. So from a performance point of view, it has been fairly decent, right? Now let's understand a little bit more about this segment. So the sales mix is currently around 75% external and 25% internal segment, inter segment, right, which is mostly to FMCG. Now this was around 60-40 back in 2011, 2012, and it has changed, right? So the share of external has went up and share of internal has actually gone down, right? Now it's a market leader in both in terms of volume and also the product range. And product range, as I talked about earlier, I think is going to be key, not just product range, but product innovation, right? It is the market leader in India. It is also the largest value added converter of paperboard packaging in South Asia. So you can understand the company is operating at quite a scale. And in fact, it is trying to compete not just with not with Indian companies actually, but with global companies as well, right? Based on the information that I could find from the website, it has 4 units with a combined capacity of 630,000, I would assume, TPS tons per annum for the boards, and 174,000 tons per annum for paper, right? So that is the capacity of the units that this segment operates, right? It provides packaging services to several well-known Indian and international FMCG companies, a lot of household brands that we might understand, right? Now the most important thing, which are the eco-friendly product innovations. So they are able to make biodegradable paper boards. They also have 100% recycled papers, right? And I'm sure they're going to introduce things, use those in packaging services as well, because with all the waste that is being produced in the form of packaging, the consumers and the companies are also going to get a bit cautious about the way the products are being packaged, and we might look for more environmental friendly alternatives. So that is going to be key going forward, right? Now we have hotels. So the hotel portfolio of the company is something looks like 14 ITC hotels, which is the flagship or the luxury chain of the company. We have 30 Welcome hotels, which is also on the 5-star end. We have 45 Fortune hotels, which are on the more affordable side, and 35 Welcome Heritage hotels, which are probably something like resorts, right? And the capacity also, as you can see. Right now, the performance, right? So here, please don't get confused about the stable increase. These are assets. The revenue is the shorter column here, right? So 6.8% revenue CAGR, EBIT CAGR is actually negative because it fell from around 270 crores to here, I think around 150 crores, right? And it fell to as low as around 50 crores, 60 crores in these years, right? So you can understand that the performance has been not so good. Assets have grown. Understandably, you need to invest a lot of money into assets because it is an asset intensive business, hospitality industry, right? The margin has been is around 10%, but it has been very volatile. It fell very sharply in the recent years here. It has tried to recover a bit, and you can say in the recent years it has been stable around 10%. Right? Asset turnover or asset utilization, as you can understand, is very low because that's just the nature of the industry, right? So now the company switched its focus to an asset-light business model, which basically says that the company is going to focus on managing properties rather than owning properties, right? Because obviously to own properties, you have to construct them. It requires a lot of capital as well. But when you're just managing properties, you need to have a good team, and you can manage properties for other owners as well. Currently, the mix is around from of owned to managed around 40 to 60, but they are trying to move to 30 to 70, right? So they're trying to move majority of the business to manage properties. I would assume that they will keep most of the ITC hotels, they'll keep slowly expanding that, which is the luxury or the flagship chain. And most of the other hotels, they will, try to get as much expansion as possible through the managed properties route, right? Now, we obviously understand that the hospitality has suffered tremendously due to COVID, as we also see the trailing 12 months profit was actually negative, right? So the 2 quarters here in this year have offset the earnings in the 2 quarters in the previous financial year, right? So it's most certainly to result in a negative contribution to earnings in FY21, right? Now, talking about how the hotels operate, so they have a sort of exclusive tie-up with Marriott's luxury collection. So Marriott also manages different properties, and a lot of the ITC hotels also come under one of the Marriott's, the luxury collection, right? And because of the problem with the coronavirus, the company had to introduce a program that it has followed all the guidelines, and it is able to provide its guests the highest level of safety and hygiene. So that is very, very important, obviously, in these times and also going forward in the near future, right? And finally, all the ITC hotels, the 14 ITC hotels that you see, are LEED Platinum certified properties. What it basically means is that they follow the highest practices in environmental friendliness, right? So ITC hotels try to call themselves as, responsible luxury. So responsible is basically that they are saying that they are, very environmental friendly as well, but I'm not so sure that how much emphasis do customers put while booking rooms on this. Nevertheless, it is something that is unique to the hotels of this company. Finally, we have the IT services business, so within which there are three broad segments, and they provide a lot of unique services, which they cannot provide the large scale services that the large IT companies provide. So they're operating in niche segments, right? So app development, maintenance, ERP systems, testing. Then you have digital transformation, experience transformation, because a lot of businesses are trying to move digital. They have an intelligent platform and database for managing information, right? Then with respect to product, they have a development life cycle management, because as products move through different life cycles, they have to be managed differently, right? Supply chain management, so on and so forth. This is the financial performance of this division. So you could see a very healthy growth rate in revenue and EBIT as well. So EBIT is nearly 20% despite the sharp fall here, right? So in these 4 5 years it was very strong, fell here, and has again started to recover. And despite the fall, it has been able to maintain very solid growth rate, right? As the company has kept on investing into its business as well, in terms of assets, but the asset requirement are not as much as let's say a hotel segment, right? Now the margins currently, you'll say the median margin is currently on the lower side. You would expect this to push up to about 16 17, because that's where the competitors also lie, right? So on the margin side, the company is lagging a bit behind, right? But overall it's a good industry and good growth as well, right? So the first and most important thing of the IT services is the tech backbone of each of us. So each of us is basically a tech ecosystem, right? It's a tech enabled supply chain and all the related services. So without tech, the each of us cannot exist, without which the agriculture ecosystem cannot exist, and without which the FMCG isn't as attractive as it would be, right? So this is very important as well. The different industries that it serves are the BFSI, which is banking and financial services, the consumer goods, healthcare, hospitality, manufacturing, and travel. Right? These are most of the industries are being covered here. Now, as I was talking about, the company's focus, from my understanding, is on niche and differentiated offerings, right? Because it cannot operate in scale. If you look at here, then its revenue is around 2,200 crores. It's still on the smaller end of the industry, because We have giants like Infosys or TCS who are in several tens of thousands of crores as well, right? So it's on the smaller end of the industry, right? So that is why it has to offer. I mean, you can say they choose to offer, but I think that they cannot compete on scale. So it's a smart decision on that front, right? Now, in order to grow, what it has also done, it has formed partnerships with industry leaders. So we understand that there are several B2B software providers or several B2B companies as well, right, which provide software services or software products to companies. So they have partnered with a lot of these companies, and my understanding is that they are helping their clients, apply all of those technologies or all of those products being provided by the large IT service providers or IT products or IT platforms providers, right? So in that way, it can use the best products in the industry, and it can help their clients, implement those products in their organization, right? And finally, we have the innovation lab. So it is, sort of a startup division, so to speak, within that segment, where they are focusing on emerging technologies. We see a lot of trend of augmented reality, virtual reality, bots or conversational systems and drones, so on and so forth. So this is something that, keeps on changing, and they keep exploring different ways in which these new technologies can be applied to its clients. So that is all that I had to share about this company. I hope that you were able to understand the business that ITC is, and we can forget about the stock price for some time. So I think that the business is at a very good position where it can have a very good decade going forward. But I can be wrong, and this is something that we have to see. So thank you so much for watching. If you want to take a look at the presentation, the link is in the description. Right? If you have any questions, please drop them in the comments. I'll try my best to answer. If you found this helpful, then please share it with someone who's interested in the company. And if you want to receive updates, then you can just drop a comment below. Thank you so much for watching, and I'll see you soon with a detailed analysis of another company.